The yield curve inverting even more, and the state of the U.S.-China trade war continues to remain uncertain after conflicting statements from President Trump. Joining us now is Nathan Bomey, business reporter at USA Today, and Jim Bianco, president and macro strategist at Bianco Research. Guys, it's great to have both of you on Cheddar Business. Nathan, I want to start with you. Give us your predictions for how the U.S.-China trade war will end. Is it going to happen before 2020 as the pressure continues to mount?
Well, if I could predict that, I think I should probably be in another business. But I think the difficulty here is that, to use the parlance of the fiction writing world, we have a bit of an unreliable narrator in the form of Donald Trump, or if you want to be a little less charitable, someone who's, intentionally misconstruing the way that these negotiations are going. Because just this last weekend, when he said that China wants to come back to the table, there's some serious questions as to whether China said anything at all. So when we're not getting the right information on exactly how these negotiations are going, it's really difficult to predict how this is going to end. I will say, though, that it does seem like time is running out for a deal. I think China maybe feels like they can run out the clock in some ways. And, the Trump administration has gotten a lot of traction among its base with these types of threats and the negotiation. The fact that they seem to be doing something seems to play well with the base. So, the fight maybe plays better than a resolution in some ways.
And Jim, to you now, Nathan, we'll come back in just a sec. There are so many factors now converging. On top of this, of course, the inversion of the yield curve, portions of it that keep happening in the last 2 weeks or so, coupled with the U.S.-China trade war concerns here. How worried are you about a recession in the next 12 to maybe 24 months?
I'm very worried about it. The yield curve is a simple concept to understand at its basis. When long-term rates are lower than short-term rates, as they are right now, that is the market sending a signal that the Fed funds rate, the rate that the Fed administers, is too high, and they have to come down. Now, why are they lower on the long end of the curve? Because there's fear of an economic slowdown. And it's also fear that the Fed is going to move too slow in trying to address this situation as well. This historically has been one of the better indicators of a recession. Now, just because we've inverted doesn't mean we're in recession. I like to say it means that we have the wrong rates, the wrong interest rate at the short end of the curve, or the funds rate, and it hurts the economy. Today it hurts the economy, tomorrow it hurts the economy. It's hurted the economy for the last couple of weeks. If this continues long enough and it accumulates long enough, it can push us into recession. We don't know how strong the economy is, how much it can take of this, but we're playing on the edge right now. And the market is demanding that the Fed get more aggressive, and they're doing anything but that right now. They're talking about going slow and being very deliberate.
Well, what's your strategy, Jim? How are you trading right now?
The long end of the yield curve right now, 30-year bonds, 10-year bonds, are having among their best rally in history. In Europe, they're having among their best rallies ever seen in 5,000 years of interest rate data. We are having a historic rally. Negative interest rates. You could get 60, 70% returns on some of these negative interest rate securities in Europe. You can get near 25% returns this year on 30-year bonds. That's way more than the 15 or 16% that the stock market is giving you right now. They are going to continue to do that until we see signs that the economy is recovering or the Fed is going to get aggressive and start cutting rates by 50 basis points at a chunk.
All right, Nathan, I'm going to come back to you, and Jim, I'll throw you out the same question as well after Nathan. Is there a connection here at all between what the U.S. is trying to do, pressuring China with these trade talks, and what's happening in the broader economy, not only here in the U.S., but also abroad?
I certainly think there's a connection, and I think that there's a concern at this point that we may have finally reached a tipping point when it comes to these tariffs. I think when it first started, there was a lot of talk about it, but I'm not sure it had a big impact at the beginning. But when we start to see 25% or 30% tariffs on hundreds of billions of dollars of goods going each way, that's where I think there's some serious concern, especially when you've got the holiday shopping season approaching. If toys and sporting goods really get hit hard, then I think you could see a pullback that would trickle down throughout the entire economy, and perhaps that could push us into a recession.
And Jim, same question to you.
Yeah, I think what we might have miscalculated on is the weakness of the global economy. Europe is essentially in recession. Germany is in recession. Japan is being forecasted to have negative GDP, which is the first sign of a recession later this year. China's economic growth is the lowest in 28 years. It was at that point we decided to get tough on China. Our economy was strong, but we're really hurting the world economy right now. 40% of S&P 500 revenues come from overseas. And if overseas is looking recession left, recession right, it's not going to be good for our economy and our stock market as we move forward.
Nathan, look, with the caveat that you're not a financial advisor, at least not to my knowledge, and you write for a broad audience, and you do not give advice per se, what is the typical investor to do? The person who has maybe money going into their 401k, maybe does a little trading. How should they be digesting this news, maybe daily, maybe not daily?
Well, I think it's really dangerous for the average investor to make any severe changes to their portfolio based on what's happening here. I think, most of us, to be honest, should probably try not to be professional investors and should think for the long term. In the end, the stock market over time tends to increase. And, I think that for the average person who can't really sit there and crunch the numbers every day, that's probably the best, is just to stick, because even those who are professional in a lot of ways can't beat the S&P 500 index on an average year. So it's just really dangerous to be thinking too much about trying to play with the market. That said, if you have serious concerns, you should certainly consult with an advisor and think about whether you need to pull back at this point.
And Jim, as you are an investment professional, I mean, when you hear something like that from Nathan, I mean, this is our day job, right? Looking at the markets, trying to look at the numbers and understand what the story is. What are you then benchmarking against if not the S&P? How are you measuring your own performance?
Yeah, I mean, the S&P is the benchmark performance metric that everybody uses right now. And I could just kind of reiterate what Nathan said. I assume that most investors have a plan, and that plan includes looking at the possibility that things could change. I would argue to you that what we've seen with the trade war, the inverted yield curve, the slowdown in Europe is we might be close to a change. Now, that doesn't mean we've changed. That doesn't mean it's time to move. It does mean that you should be at heightened concern about whether or not this is just a summer storm or if there's a full-blown hurricane coming at us right now. It's too early to tell at this point, but it is definitely worth tracking.
All right, well, a big thank you to Nathan Bomey, business reporter at USA Today, and Jim Bianco, president and macro strategist at Bianco Research. Guys, it is always great to have both of you on the show. We really appreciate you taking the time this morning.